My name's Andy Ritchie, and I look after sort of majority of farming and landowning clients. I've probably looked after them for 30 years perhaps. I've got a fair amount of experience over the years and looking after them, providing a lot of succession advice, tax advice, and all that goes with it. I guess being a CA and that looks after rural businesses. We've got a family farm, we just farm outside Perth. I worked on the farm when I was younger. I think I've probably broken most pieces of machinery over the years, and so my parents kind of encouraged us to go and do something else. And so I'm still a partner in the business. I don't do any practical work, thankfully. I think for all my brother and my father, they don't have to repair anything any longer. But I think they get a cheaper tax and accountancy service if they keep me as a partner. So yeah, that's kind of my background in farming. Azets is a large accountancy firm, covers lots of different businesses, mostly SME clients, so small and medium-sized businesses. We've got offices right throughout the UK, and I guess my role in that is probably one of the kind of farm advisors, and we look after lots of farmers, hundreds of farmers actually, throughout the UK, all different sectors. And most of the team that are with us are, not most of the team, but a lot of the team are actually farmers' sons or daughters. They've got some sort of link to agriculture. And that's essentially what they do, look after portfolio clients. As you know, there's lots of different types of clients, but predominantly it's probably family businesses, which are partnerships. That'll be our core of our kind of business. So I think we'll cover some inheritance tax because that's been a concern to a lot of our clients, and major changes on the last budget. So I think we should cover the basics just to give people a kind of basic understanding, and then we could maybe look at an example and see if we can kind of talk through it. Obviously not providing advice. This is really just highlighting things that people watching this should speak to their accountant or their lawyer about when they come to succession, and just hopefully provide a bit more information so that they're slightly more aware of what inheritance tax is and what the changes are. Unlike other businesses, farms do tend to get passed down from generation to generation, so it's always been important. And I guess it's just become more in focus because of these changes, because historically, in a large amount of cases, you could probably pass the farm on with no inheritance tax. I guess fundamentally, inheritance tax is due on the death of an individual, and it's due on the assets that are held by that individual on death. But not only that, we look back the 7 years previous, and we pick up any lifetime gifts, and they're included in the estate. And fundamentally, that's what inheritance tax is paid. It's paid at, if it's due, it's paid at 40%. So it's a fairly high rate if it is due. So anyone's death, the executors will, with the help of lawyers and accountants, will pull together a list of assets that the deceased owned and gifts. And they will value those assets. So it just depends on what the deceased owned. So if it was a sole trader farmer, it's relatively straightforward. Just value what he or she owned at date of death. So that would be, you would get a land agent to value the land and the property, and any other assets that are owned. If it's the deceased was perhaps a partner in a business, then we'll look to value their partnership interest. And that becomes a bit more complicated because we then have to look at what the partnership agreement says, and that will dictate what we're valuing and how we're valuing it. And obviously, if the deceased owned some shares in a company, and it was a limited company, that's different. So it's important to, if the partnership owns all of that, then often if we look at the partnership agreement, it'll say, well, on retirement or death, that we have to revalue the heritable property, i.e. the land and buildings. So we would revalue that, and they would adjust the partner's capital or current account in the business. Often it doesn't require a revaluation of stock or plant machinery, but again it could. It just depends on what is said in the partnership agreement. If it's a sole trader, and let's say there's nobody succeeding, then ultimately it will be valued at the market value of all those things. Everybody in the UK as an individual will have what they call nil rate band. So that's 325,000. And that's been the case since 2009, so quite a long time. There's been no inflation adjustment in that, and that will be the same until announced in the budget until the 5th of April 2028. There's also the ability to transfer that to your surviving spouse. So if I'm married, I die, I leave everything to my wife, then on her death, she has my 325,000, so effectively has 650,000. So that's called the nil rate band. We then have the residence nil rate band, and that's where if I own a property on death and my assets on death are below £2 million, I get essentially an extra 175,000. And again, that's transferable. And that's why you hear a lot of people say, well, you've got £1 million of relief. In theory, you do if you're married, because you and your wife have that, potentially have that nil rate band and the nil rate residential band. Once you get to total assets over 2 million, that residential band reduces. And once we get to 2,350,000, there is no residential band at all. So it's not, the residential band is not available to everyone. So that's two of the kind of reliefs that everyone gets. And then apart from that, you have your agricultural property relief, which is shortened to APR, and then you have your business property relief, which is shortened to BPR. The way to look at it is agricultural property relief. If we look at a farm, agricultural property relief is everything that's used for agriculture. So in the simplistic term, it's the fields, it's the roads to get to the fields, it's the steading, it's the farmhouse, it's cottages provided they're occupied by employees. So that is all used for agriculture. So that gets agricultural property relief. And if you're just a farmer who's working your own farm, essentially you will get APR on those. There's a couple of kind of quirks, if you like. The farmhouse, you get APR, but there's a few tax cases that have happened over the last 10, 15 years, which essentially say that you only get APR up to the agricultural value. So the best way of thinking about it is if you've got a really nice farmhouse on the outskirts of Edinburgh, then it has a value beyond agricultural value because of what it is. Somebody else would buy it not just for agricultural purposes. And therefore, there's a restriction on how much APR you get on your farmhouse. And it just depends on the type of farmhouse, where it is, and as to how much the restriction is. So it's important to realise that you won't necessarily get APR on the whole value of the farmhouse. Now, BPR, business property relief, in a farming context, is given to all other areas of the business that's not used for agriculture, but it is used in your business. So an example of that might be you let a couple of fields for livery. So it's used in your business, but it's not actually used for the purposes of agriculture. So you're not going to get agricultural property relief on it, but you may get business property relief on it. So another example might be if you had a phone mast. Same thing. It's in your business, it's generating some income, but it's not through agriculture or let cottages. And so businesses can, and often do, because farming businesses are diversifying all the time, they're doing lots of things, they will qualify for APR and hopefully BPR as well. Up until budget date, effectively, and I think the thing to state is actually a lot of the rules haven't changed. All they've done is change the rates. Okay, so inheritance tax largely is unaffected, but the rates aren't. So the announcements at the budget were really to say is, you used to get 100% relief on agricultural property and business property in most cases. And after budget date, they're only going to give you 100% on the first £1 million. Okay, and after the £1 million, you get it at half rate. So it's still beneficial, but it's not as beneficial as it was. The £1 million is per person, and it's not transferable. So it's not like that nil rate that we were talking about, where you can pass it on to your surviving spouse. On death, you lose that. these are all as it's proposed. It's not legislation yet, but that seems to be that's certainly what the announcements are. There's not going to be that transferable amount. So of course, now we're in a situation where the majority of farms are worth more than £1 million. So therefore, we're in a situation where inheritance tax is definitely payable. And depending on your age and how the farm's owned and all of these things, all different for all circumstances, means that in a majority of cases, there will potentially be inheritance tax payable. The rules come in, these changes come in on the 5th of April, or the 6th of April 2026, albeit they do affect gifts that are made after budget date as well. Again, it's only as proposed, but at the moment that will affect particularly, I guess, landholders who are more elderly, because if they are going to gift, they've got to survive the 7 years for the gift. And if you want to try and cover it in another way, such as life assurance, then that becomes restrictive, if at all possible. On somebody's death, you look back the 7 years and you pick up the gifts that are don't qualify for any other relief, if you like. And the tapering works, and it's relatively complex, but the tapering works after you've gifted and you've survived 3 years. You get a taper, you get a reduction on the inheritance tax liability. So the taper is on the tax liability, not the gift. So you get a taper of 20% after 3 years. After 4 years, you get a further 20%. After 5 years, another 20%. So once you get to 7 years, it drops out of your estate completely. So we've got a Mr. and Mrs. Green. They're both 60 and they're farming as partners in the family business with their son. And at the moment, or currently as it stands, let's say Mr. Green, he owns the farm, and he's going to leave that to his wife on his death, assuming he dies first, and then she will leave that to her son. So I'll just take you down the assets that they own. So we've got the partnership assets, we've got agricultural land, it's got a value of £3.5 million. The relief against that, so on the second death, it's passing to the spouse, so nothing needs to happen on first death. Second death, there's the first £1 million of relief, and after that, we're basically getting 50% of £2.5 million. So the relief is £2,250,000, leaving a chargeable amount of £1,002,050. The farmhouse, you'll see there's a little asterisk next to that, and we kind of covered that earlier. The farmhouse is, we're saying that it's worth £500,000, but its agricultural value is £400,000. So it's only getting 50% relief on £400,000. So £200,000 leaving chargeable of £300,000. Farm buildings, £400,000, again 50% relief. The rental property, and I'll just talk about the rental property for a bit, because normally on somebody's death, rented property, so if I own some flats or something like that, I wouldn't get inheritance tax relief. But in a farming situation, you can do. And in this particular example, we've got the partnership owning the farm, and it has a couple of cottages or maybe one cottage. Provided that business is mainly trading, you will get relief on things like let cottages for inheritance tax. So that's why we're getting relief in this example on the let cottage. The important thing for farmers to ensure is to make sure that the business does not become what they call wholly or mainly investments. And that means you lose all your business property relief. So that might happen if you had a very diversified business that was perhaps earning a lot of money from rental income. So it could be wind turbines or solar farms or something like that, which pushes it over mainly a trading to business. But in this example, it's pretty straightforward. They've maybe got one cottage or two cottages which have got rental income. So it's going to get business property relief. And then we've got the balance on the bank, 50,000, gets relief. Again, it will get relief, but if you've got excess cash in the business, it will not get relief. It's treated as an accepted asset. But in this example, we're fine. And they've got another 350 cash or investments that they have that's going to get no relief. So in summary, we've got a total value of the estate of £5 million, and we're getting relief of 2,775,000. That's leaving 2,225,000, and they have both the nil rate bands, so the 2 times 325,000 taxable estate, and we've so effectively inheritance tax due on the second death at 40%. In this example would be 630,000. That 630,000, as the proposals are at the moment, would be paid up over 10 years interest free. Now, whether that comes through to legislation, but that's what the announcements have been. So that's a kind of it gives you an illustration of what happens if actually you just wait until death and how much would be due. Now we're going to look at the second slide, which is exactly the same situation, same values, but this time Mr. Green is going to do a lifetime gift. So he's going to gift the farm during his lifetime to his son, and just to make the example relatively easy, he's going to pass all of the investments and bank accounts that he personally had, the 350,000 to his wife. And so you'll see there on the first column, if there was a death within 3 years, there would be exactly the same amount due. There would be the 630,000 in inheritance tax due. So no different to holding on until second death. If he survives but doesn't survive 7 years, he survives more than 3 but between 4, you'll see there's a reduction. There's a reduction in the inheritance tax that's due, a 20% reduction on the 720. And for each year after that he survives, there is a further reduction of 20% until you get to 7 years where it drops off completely. So that shows you the difference between what happens if you do a gift during lifetime and not. And some of it will be to do with, it could be the age of the farmer, all of these things. But you can see even the simple example that actually there's quite a few changes that could be made that could reduce the inheritance tax. It could be that actually Mr. Green gifts half the farm to his wife during his lifetime, and then they're both allowed to have the £1 million. So that immediately reduces the overall inheritance tax that would be payable. They could do something with the farmhouse. Perhaps they retain the farmhouse, and provided their total estate came below 2 million, they would access the nil rate, the residence nil rate band. They could look at life assurance, and could they effectively get a life policy so they do a gift, it essentially covers that inheritance tax. And that life policy would be structured such that it would reduce with the tapering. And there's different ways of doing that, but that's something that they would speak to the financial advisor. So there's planning opportunities. I think that's the thing to get across. There's planning opportunities that can be tailored so that it reduces the overall exposure. For the inheritance tax cover, of course, these rules don't come in till the 6th of April 2026. So if something disastrous was to happen to somebody young before that, the current rules apply. So you're getting the 100% relief where it's due. But after then, yes, definitely, I think that's going to be one of the major changes that comes out of that. Anybody that's got any sort of IHT exposure, regardless of age, will consider life assurance. And obviously, as you get older, it becomes too expensive or not available. But if you're relatively young, you're relatively fit, the cost of life assurance will be pretty small in comparison to the potential inheritance tax that could paid on a disaster. What we've got to remember is that, first of all, these are just announcements. There's no point in panicking. There's loads of information even in this kind of short video to kind of try and absorb, and you're not you're not going to manage to do that. But there's no point in panicking. Your accountant, your lawyer, your farm advisor, they'll all be there to help. And there's planning opportunities and there's steps to take that can mitigate it in a large amount of cases. So I think that it's no panic. I think that's the kind of message I would say. Just take it in steps, work out what your liability is, work with your advisors, and you can put yourself in the best position to mitigate any tax.